moving on. When we first met, baby, everything was alright. But later on, baby, you're just gonna fuss and fight. Now that's just one thing to say now, baby, we're moving on. I'm moving on. Moving on, babe. I just won't be around no more. I'm moving on, babe. Moving on. I just won't be around, babe. I can't stand to be hurt no more. I got to leave you, baby.
Dressed up like something from outer space. Elton John, David Bowie, Alice Cooper, Lord have mercy, they're all super.
Don't forget Mick and the Mad Rolling Stones. Every night their attendance is 100,000 strong. Don't stand there and point your finger at me. Just take a closer look, y'all, and you will see there's a method to the madness.
I've been trying to tell y'all.
It's the truth, it's the truth. There's a method to the madness. It's the truth, it's the truth.
I see what you wanna do, some freaky to you. Take you to another place and time. Just sit back and close your eyes and let us take control of your mind.
Tell me all, how high do you wanna go?
Come on, boys, to that.
Come on, y'all, fly with me. Ooh, ooh,
Variety is the spice of life.
we love music, music is our life. Fame is what we're after. Take it to the top. You gotta method to the madness.
I keep trying to tell you.
It's the truth, it's the truth. There's a method to the madness. It's the truth, it's the truth. There's a method to the madness.
I keep trying to tell y'all.
It's the truth, it's the truth. There's a method to the madness. It's the truth, it's the truth.
Ladies and gentlemen, dear guests and colleagues, good afternoon and welcome to the Central Bank of Cyprus. It is a great pleasure to host today's research, policy and practice session on empowering households in their financial behavior, coordinated with the Centre for Economic Policy Research, CEPR. This event is part of the CEPR European Conference on Household Finance 2024, which is taking place over the next 2 days here in Cyprus. Today, we aim to explore the evolving trends in household financial behavior, focusing on how improved financial literacy and robust consumer protection policies can strengthen household financial resilience. Financial literacy has never been more important, both globally and here in Cyprus. As we navigate an increasingly complex economic landscape, empowering households with the knowledge and skills to make informed decisions is crucial. Financial literacy is the foundation upon which individuals can build secure and stable futures. It enables people to manage their personal finances effectively, make informed investment decisions, and protect themselves from unexpected events. Recent financial crises have taught us that promoting financial education is essential to ensuring resilience, both for households and the broader economy. Financial literacy alone, however, is not enough. Consumer protection is a crucial pillar that supports this strategy. A well-informed population must also be protected by strong regulatory frameworks to ensure fair practices, transparency in products, and access to clear information. As consumers increasingly engage with digital financial services and sophisticated products, national authorities should remain committed to safeguarding their rights. As we embark on today's discussion, our focus is on finding ways to empower households and individuals to achieve financial independence, security, and resilience, ultimately leading to a greater level of financial well-being for them. So now, without further ado, I will invite Professor Michael Haliassos to the stage to deliver his welcome address. Professor Haliassos has held the chair of macroeconomics and finance at Goethe University Frankfurt since 2004, after previously serving at the University of Cyprus. He is a research fellow at the Centre for Economic Policy Research and NetSPAR, and the founding director of the CEPR Network on Household Finance. He also serves as a research professor and member of the executive board of the Institute for Monetary and Financial Stability. Among his extensive roles, Professor Haliassos has advised the European Central Bank on Euro area household finances and consumption survey, and has served as director of the Centre for Financial Studies and a founding director of SAFE. Since 2023, he serves as vice president of Convo's Node Networks of Global Hellenism. MBA graduate from Cambridge and a PhD one from Yale University, his groundbreaking contributions to household finance have established him as a leading figure in the field. Professor Haliassos, please come to the stage.
Thank you very much. This is a very generous introduction, and among my distinguished colleagues in the household finance field, I feel one of many extremely influential and hardworking people in this area. So, Mr. Governor, distinguished panelists and guests, dear colleagues and students, ladies and gentlemen, it is a great pleasure to be welcoming you here in my capacity as director of the CEPR Network, Research and Policy Network on Household Finance. I want to begin by thanking our sponsors, and in particular the Governor and the Central Bank of Cyprus for giving us this very nice room, and more importantly, this opportunity to interact with you all, and also co-sponsoring the academic conference that we will be holding in the next 2 days. I want to say about CEPR, the Center for Economic Policy Research, that it is an independent, non-partisan network of more than 1,900 researchers in economics and finance, mostly in Europe, but actually located in other places around the world, many in the US, in Australia, in Asia, and other and other places. Each year, CEPR sponsors more than 250 academic conferences and workshops all over the world. There is the CEPR policy portal, voxeu.org, which has an audience of over 7.5 million views per year, and which I invite, all academics and policy makers and interested members of the financial community to consult. CEPR is poor, is not rich. If you actually look at CEPR, it's a few offices. It gets funding from the French government now that it has moved, following Brexit, its headquarters to Paris. But it has many corporate sponsors, and it includes among its sponsors most of the European central banks and some also central banks outside of Europe. Our network was established in 2015 as a continuation of activities in household finance research and in organizing conferences that started much earlier and have been going on for decades. And some of us here, also in this room, have been together for, decades, and I'm not going to admit how many, and collaborating. So we hold one workshop and one conference every year. It's a very popular network. All our locations are booked now until the end of 2027. So actually making sure that one of them was Cyprus was a big thing, and we're very happy that this has happened. Okay, I won't take more of your time. I would like, will you do it or do I do it? You will do it. Okay, I would like to pass on to our mistress of ceremonies today, and then we do more. Okay.
Thank you. So it is now my honor to invite Dr. Christodoulos Patsalidis, the Governor of the Central Bank of Cyprus, to deliver his introductory address, Building Household Financial Resilience in Cyprus, the National Strategy for the Promotion of Financial Literacy. Dr. Patsalidis holds a PhD in economics from the London School of Economics, and his career spans over 30 years in both the public and private sectors. His professional journey began at the Central Bank of Cyprus, where he worked for the Department of External Debt and Foreign Exchange Reserves Management. He then went on to spend nearly 25 years at the Bank of Cyprus, holding senior positions and eventually rising to the role of First Deputy CEO. Dr. Patsalidis also served as chairman of the board of the Association of Cyprus Banks and the Artemis Credit Bureau. In addition to his extensive banking experience, Dr. Patsalidis has provided advisory services in the banking, insurance, and asset management sectors, both locally and internationally. Since April 2024, he is the governor of the Central Bank of Cyprus and a member of the Governing Council of the European Central Bank. Dr. Patsalidis, please join us on stage.
Distinguished guests, esteemed colleagues, ladies and gentlemen, it is with great pleasure that I welcome you to the Central Bank of Cyprus for today's international event. We are delighted to host the Research, Policy and Practice session of the Centre for Economic Policy Research European Conference on Household Finance of 2024, organized these days in Cyprus. The theme of our session, Empowering Households in Their Financial Behaviour, is both timely and globally relevant. Empowering households in their financial behaviour constitutes a multifaceted and long-term set of challenges for both researchers and policymakers. These challenges include maintaining a balanced, effective, and efficient regulatory framework to protect consumers, ensuring broad access of the wider public to financial services and promoting financial literacy and education. Successfully addressing these issues is necessary for navigating the complexities of the modern financial landscape. Our distinguished panelists will discuss these topics from an international perspective. In my introductory address, I will focus primarily on one key challenge we face in Cyprus: building household financial resilience by advancing financial literacy and education, particularly through the implementation of our national strategy. In addition, I will share some preliminary conclusions from recent work conducted at the Central Bank of Cyprus, underscoring the critical importance of both financial literacy and regulation, not only to households, but also to financial stability of the country. At the Central Bank of Cyprus, we are striving to be a center of excellence that supports the well-being of our citizens and our society. Financial literacy is a fundamental prerequisite for financial well-being and household resilience. It encompasses the ability to understand and effectively apply a range of financial skills, including personal financial management, budgeting, and investing. In today's increasingly complex world, where financial products and services are more diverse and digitized, the need for financial literacy has never been greater. Cyprus has faced significant financial challenges from the stock market crash in 1999-2000 to the 2013 banking crisis, underscoring the critical importance of financial literacy. A financial literacy survey conducted in Cyprus in 2023 in collaboration with the OECD confirmed significant gaps in financial literacy across various demographic groups, consistent with findings from a 2018 Central Bank of Cyprus survey. These results emphasize the urgent need for targeted financial literacy initiatives to enhance the financial well-being and resilience of the Cypriot population. The 2023 survey results revealed that the average financial literacy score among the population aged 15 to 79 was 56 out of 100, with only 17% of respondents achieving the basic financial competence benchmark level of 70 points. This indicates a widespread deficiency in essential financial skills, which can have serious implications for household resilience. Disparities in financial knowledge are particularly concerning, with individuals lacking a high school education scoring an average of 49 out of 100, compared to 61 among those with tertiary education. This gap exacerbates economic inequalities and increases vulnerability to financial shocks, particularly among lower income and less educated individuals. Moreover, the results of the survey align with other studies confirming that financial resilience in Cyprus, that is, the ability of the households to cope with unexpected expenses or income disruptions, is notably low. Only 22% of the population reported they could handle a major expense equivalent to their monthly income without borrowing or seeking help from family and friends. Additionally, 38% of respondents indicated that their income did not cover their living expenses at some point in the previous 12 months. These results suggest that many Cypriots are ill-prepared to manage their financial affairs effectively. The lack of preparedness can lead to poor financial decisions, increased debt, and reduced financial resilience, especially during adverse economic downturns or personal financial crises. Addressing these challenges is crucial, but it is equally important to ensure that consumers are shielded from unfair practices and empowered by clear, balanced, and effective regulations. Effective consumer protection frameworks must complement the efforts to advance financial literacy in Cyprus, ensuring that individuals are not only well informed, but also safeguarded against risks such as fraud or unfair practices that threaten their economic interests. Also, market imperfections such as information asymmetry can leave consumers vulnerable, particularly in complex financial transactions like loan agreements. Loan origination, the process by which lenders assess the creditworthiness of potential borrowers before approving loans, plays a critical role in this context. Borrowers may not fully understand the terms, conditions, or long-term implications of their financial commitments, leading to decisions that could undermine both household well-being as well as broader economic stability. The Central Bank of Cyprus recognizes its role in this area. Following the 2013 financial crisis, we implemented a series of banking regulations and reforms designed to stabilize the financial system and prevent future crises. These measures were part of the broader economic adjustment program agreed upon with the Troika, including a comprehensive framework for resolving non-performing loans, mandating rigorous loan origination processes, and establishing specialized units to manage distressed assets. Additionally, we have strengthened oversight to curb unfair practices and minimize the risk of consumers being misled or exploited. To underscore the importance of combining financial literacy initiatives with effective regulatory frameworks, a recent Central Bank of Cyprus study explored the link between financial literacy and financial stability. In two different regulatory regimes, a relaxed one prior to 2013 and a robust one after 2013, and the creation of the single supervisory mechanism in 2014. Drawing on data from the Household Finance and Consumption Survey, HSFC, the study empirically revealed that higher financial literacy reduces loan defaults, emphasizing the role of financial education in mitigating credit risk and enhancing financial resilience. Furthermore, the study showed that post-2013 regulatory reforms, particularly those related to loan origination, appeared effective in reduced loan arrears, demonstrating the importance of integrating prudent regulation with financial literacy efforts. The enduring impact of these regulatory measures was also evident during the COVID-19 pandemic and the challenging environment of high inflation and geopolitical turmoil. Despite these economic disruptions, non-performing loans in Cyprus continued decreasing, underscoring the resilience of the financial system. This evident resilience highlights the critical role of robust regulation, resulting in best banking practices and the further strengthening of financial education. Against this background, the Central Bank of Cyprus, in collaboration with key stakeholders, that is, the Ministry of Finance, the Ministry of Education, Sports and Youth, the Exchange and Securities Commission, and distinguished academics, developed a comprehensive national strategy for the promotion of financial literacy that was endorsed by the Council of Ministers in June 2022. As of June 17, 2024, the Cyprus Financial Literacy and Education Committee, CEPR, has commenced its activities and is fully operational, undertaking the implementation of the national strategy's goals and objectives. The Governing Board of CEPR has already approved the formation of 4 thematic project teams, each dedicated to a key area of financial literacy. First, the ongoing evaluation and revision of the national strategy. Second, the integration of financial literacy into school curricula across public and private institutions. Third, the promotion of lifelong learning with an emphasis on vulnerable groups, and fourth, the enhancement of digital financial literacy. On the occasion, I would like to commend the Ministry of Education, Sports and Youth for taking a crucial first step in the context of the second initiative above by introducing financial education interventions for third graders in high schools this academic year. Dear friends, the success of this strategy relies on the active participation and support of all stakeholders, government agencies, educational institutions, the private sector, and most importantly, the citizens of Cyprus. As the Greek Nobel Prize winner in literature, Odysseus Elitis, wrote, «Για να γυρίσει ο ήλιος θέλει δουλειά πολύ». Literally, it means for the sun to turn, it takes a lot of work. Metaphorically, the sun turning symbolizes significant change or progress, whether on a personal or societal level. Indeed, the journey to creating a financially educated society is long and filled with challenges. It demands time, dedication, and consistent effort. Each step we take today lays the foundation for a stronger and more resilient future for all. In closing, I would like to express my deep appreciation to everyone involved in the development and implementation of this national strategy. The work we are doing through CyFLEG is not just about improving financial literacy, it's about fundamentally strengthening the financial resilience of households across Cyprus. This is directly aligned with the broader objectives of the Center for Economic Policy Research Household Finance Initiative, which seeks to understand and improve the financial outcomes for households. Let us continue working together to build a society where every citizen is financially literate and resilient, capable of effectively managing debt, investing wisely, and weathering economic shocks, thereby securing a more stable and prosperous future for all. Thank you very much.
Thank you, Governor. Moving on now to the second part of this session, Professor Alex Michailidis will moderate today's panel discussion. Professor Michailidis has held the position of Professor of Finance at Imperial College Business School since 2013 and served as head of the Department of Finance from 2014 to 2021. His research focuses on household finance and the intersection of macroeconomics and finance. Prior to Imperial, he held academic positions at the London School of Economics and the University of Cyprus. He has also contributed as senior researcher at the Central Bank of Cyprus and served as non-executive member of its board of directors in 2013. Professor Michailidis holds a PhD in economics from Princeton University and MBA in economics from Harvard University, demonstrating a strong foundation in both academic and excellence and practical financial expertise. I would now invite to the stage the panel members, and Professor Michailidis, the floor is yours to open the panel discussion and introduce our esteemed panel members.
Thank you, Lena. Thanks for the kind words. I think we should take our positions here, and I'll say a few words about you, but we should all sit here. So there will be a few slides, we're going to go with the order we have here. There's going to be 4 participants, and 1 will be online from the US. So we're going to start with Dr. Magda Bianco, who is at the Bank of Italy and has been the chair of is now the chair of the OECD International Network for Financial Education. There's a lot of among other things, Dr. Bianco has been the head of the Customer Protection and Anti-Money Laundering Directorate in the Bank of Italy, something that Cyprus will benefit from hearing more about. The next presenter will be Professor Michael Haliassos. We've heard Michael's bio before. Then Dr. Jumana Salahin has been at the Bank of England, but has a close connection to Cyprus because she has been at the London School of Economics, and we know Professor Chris Pissaridis has been in these podiums before and is a close friend of the central bank, and has advised previously Dr. Salehin, who has moved from the Bank of England to Vanguard, and it will be interesting to hear when Vanguard might actually make it to Cyprus, actually. And we are going to also be joined online by Ms. Diane Thompson, who is the senior advisor to the director of the Consumer Financial Protection Bureau in the U.S. This is the agency in the U.S. that has its aim to protect the consumer. So it will be interesting to hear what Ms. Thompson will have to say. So with that, we should go with the presentations first, and then we'll have a discussion. We said 12 to 15 minutes each. Try to be on the 12-minute side, and then we'll have a discussion after everybody's done. So we'll start with Dr. Bianco.
Thank you very much. So good evening, everybody. Good afternoon. Thank you very much for this invitation. It's a pleasure, great pleasure being here. So empowering households in their financial behavior. I will argue that it's a very complex journey, a complex objective, which actually demands a set of tools to be realized. So I will argue that we certainly need financial education. We have heard by the governor just now how important it is, but it needs also to be complemented in a synergic way by certainly financial consumer protection. Here I put some reference of those who are actually working on this. I will argue a bit more about the fact that we have to work with these two big tools, but we have really to make sure more and more that with these tools we reach an objective, which is, empowering households to ensure that they are effectively included in the financial system in a qualitative way, and even more, that we ensure that their financial well-being is great. So we need to have an outcome for all this. Starting from financial education, I don't think I have to dwell a lot on this because we've heard a lot. I think we're convinced that financial education matters. We have by now quite a lot of solid empirical evidence that it matters at the individual level in terms of resilience, increasing resilience of individuals, reducing their level of unaware debt, facilitating their participation in the stock market with benefits in terms of risk diversification and their financial wealth. But we also have positive results at a more macro level for countries in terms of greater financial inclusion, average financial inclusion of people, the capacity even to implement economic reforms, countries where citizens are more aware of the economic consequences of financial reforms are better able to evaluate them, to judge even their politicians. An impact on inequalities, reducing inequalities if this instrument works well, if financial education is higher. Well, to be able to produce better, higher financial education, we need to start from where we are, to understand where we are. We already heard something about Cyprus, but actually the relatively low level of financial education is shared by many, many countries. So we need to start from data. Here are data for youth, the exercise by the OECD on 15 years old young people. And it shows a wide variation across countries. In many countries, the level of education of kids is low. We have some evidence about the relationship between financial education with ESCS, means the socioeconomic level of the family, of the parents, that is the economic framework where they live. a relationship with their level of numeracy and literacy, that is how much they learn in school, gender gaps which are shared among some countries but not many anymore when we speak about 15 years old. Data, going on with data, we have surveys also for adults, which are again mentioned. For adults, we have the same evidence. Many countries, adults even more than youth, have very low level of financial education, wide variation, as I said. Again, if we try to understand what's driving it, we see that education matters. The level of education of adults affects their capacity of having higher financial literacy. Age as well. Elderly people have lower financial education. Here we have a gender gap in most of the countries. Employment status, those unemployed typically have lower level. Different relevance of these factors in various countries. We still have not much evidence about what drives the difference across countries. Certainly having financial education compulsory in schools matters in terms of differences. In some cases, the generosity of the security system matters, but we don't have so much solid evidence in terms of macro differences. Last important set of data is the one on micro and small and medium enterprises. Here we have much less data because it's much more difficult to have surveys on micro enterprises. We started this a few years ago with the OECD. What you see is that you have a higher level of financial education among entrepreneurs, which you expect, but not much higher than individuals. So it looks like small enterprises are not really well equipped in terms of financial literacy for what helps being an entrepreneur. We actually observe that those entrepreneurs or small enterprises who are more literate were able to better face COVID, to exploit better all the help that were given by the governments, and were better able to exploit digitalization, to make a jump in terms of the use of digitalization for their activities. What to do? As I said, starting from the evidence, we are developing with the OECD, the International Network for Financial Education, best practices across countries. Here we still need stronger evidence on what works. I will say a few more words, but we do have evidence that looking to the future, we really need to make it compulsory in schools. We have some countries where this is now happening. There are differences. In some countries, it's a horizontal topic across various type of teaching, math and other topics. In other countries, it's a specific topic. There is a big issue of teaching the teachers because they are not prepared in this topic, but this is a shared understanding, a shared view. Now, the current emergency, adults. We have adults which are not sufficiently literate, and here it's a big problem because adults are very difficult to be reached. Two major teaching. First, how to engage them, make them aware that we have an issue and that they should do something about their own personal finances. Here, working with national medias, social medias is of course helping. It's not easy to have alliances with national TVs on this topic, but it's certainly, we have examples on that. Then the second step is, after awareness, is how to really teach and change behaviors. This is a challenge that we all have. It's very, very difficult. We know we have to work on segments of population because each segment has its own needs, its own language, its all, the aspects that it really cares. So we know we have to work with different segments, with different languages, different approaches. For example, women, for example, vulnerables, for example, migrants, for example, micro enterprises. One example for all women I put here. Women typically who do worse in terms of financial education are also sure that they don't know, even when they know, or they think they cannot do it. So when you work with women, the first thing is to destroy the stereotype, to convince them that it's not true. Again, with other kind of adults, you have to address different kind of behavioral biases. So you have to really work with different groups. And the last bit, which is very, very important now, is to check what works. We don't have much impact evaluation on what works. And the result might be that actually we don't see many progresses in terms of the surveys that we have. So it's really time, given that we have limited resources, that we do impact evaluation, that we understand which project works, what really realizes a change in behavior of the people we work with. It's costly sometimes. The very sophisticated impact evaluation take time, but there are now many methods that can be used also in a less sophisticated way. It's absolutely necessary. But now we come to the other pillar. Financial education by itself is very important. As I showed, it matters. But it cannot do everything. It cannot change things. We need, on the other side, to have very strong financial consumer protection. And with the strong digitalization of the financial services, this is becoming even more important. What here again, the best practices that we are observing across countries is that a good financial education framework involves 3 pillars. The first is having good regulation, of course, in place. I would say now regulation is moving more and more from imposing transparency to intermediaries, to banks and financial intermediaries, to imposing them what we call protection by design, which means asking intermediaries to develop products and services which are since the beginning designed in the interest of the final users. Well, it's very difficult. It's difficult to enforce, but this is the criterion. And then another important direction is to try and govern innovation. Innovation is good. It produces a lot of benefits, but it produces also a concentration of power. So in order for innovation to produce benefits for everybody, we really have to govern it. So regulation of innovation is important as well. Now, if you have regulation, we need to enforce it, and this is done with conduct supervision, with our role as central bank sometimes, or consumer authority, consumer protection authorities. And here there are a number of tools that help us work well. Typically, we have to work with a risk-based approach. Again, we have limited resources, so we have to focus on where problems are stronger. We have to focus more and more on actual behavior, what we observe, and we are using tools that help us really going into the actual behavior of banks. For example, mystery shopping is helping now to understand what really goes wrong in the relationship. And then tools that ensure that consumers' interests are really taken into account. For example, again, for those who do enforcement, having powers to ensure that consumers are reimbursed when they have had something wrong happening to them. What is helping now us is the technology. We are using more and more technology to help us look at the data, analyze the data in order to respond with consumer protection in the most effective way. Third pillar is mechanisms addressing individual consumers' problems, redress mechanisms. Typically ADR, alternative dispute resolution mechanisms, that consumers can activate cheaply when there is something going wrong. Again, also for this, the technology is helping in developing analysis and help the judges who decide in these complaints. All these instruments are important. Of course, there is an issue on how to ensure effectiveness of all these instruments. It's very difficult to be evaluated. So that's why we are developing thoughts about the final output of all these measures. And these final outputs are, on the one hand, the degree of financial inclusion of people. We have to make sure that actually all these different segments, all these groups have actually access to financial instruments. And this is something taken for granted in developed countries, but actually when we segment the population, we see that not everybody is having a proper access, a quality access to financial services and products. But also making sure that this access is associated to a higher quality, to a higher benefits. And again, with the digitalization, we see an increased access to financial services, but also some problems. For example, frauds and scams in payments. For example, over-indebtedness, given that it's very easy to get credit. For example, new forms of exclusion to those who are not digitalized, or even discrimination, new discrimination when using sophisticated instruments, for example, to evaluate creditworthiness. And if we go even further, the final output that we want to measure in order to make sure that we are producing results over time is to evaluate the financial well-being of people. This is a concept that it's developing now. It's not even well defined in the international framework. It's something like smoothly manage financial needs and obligations, resilience, cope with shocks, being able to pursue goals. Well, we are trying to define what is financial well-being and defining a metric to measure it. With a measure of financial well-being that even authorities, but even intermediaries can use, we will be able to make sure that actually all our efforts in terms of policies for financial education, for consumer protection, produce an output which is very relevant for individuals. So, empowering households is complex. We have a number of experiences, but actually the evolution of financial markets and the rapid innovation require to keep changing, to keep adaptive, exchanging practices, and innovate supervision as well. Thank you.
Thank you. Let's go with Michael is the next presentation.
Yep. Okay. So I would like to talk to you about the issue, of course, empowering households, but also briefly introduce a new initiative that we are starting in Greece, and we're hoping to expand to Cyprus as well. And it's the acronym is ENIA, which means concept in Greek, or ENIA, which means concern, and both apply. So households in Greece and Cyprus face, the usual things, the demographic crisis and increased responsibility for funding their retirement as a result. They have had a big share of recent crises from, the stock market crash of .com in 2000 to the financial crisis, fiscal crisis, the more recent ones, and recently also geopolitical factors in Eastern Mediterranean that are keeping us busy and worried. There are lots of background risks, like in other countries as well, inflation, uncertainty, unemployment, but also a lot about wages, about pensions, the level of pensions, the level and quality of healthcare systems, and environmental crisis. So fires and floods. So these are risks that are in the background that we cannot necessarily influence and that we cannot often fully insure against, but we have to develop our portfolios and our financial behavior in the face of those risks. And of course, the increasing variety of financial products. Now, what has been typical household responses in Greece and in Cyprus? Well, you focus on real estate because land and houses only go up and they never go down, or so people think. They avoid any financial risk. So most of the financial assets are in deposits or actually even under the mattress. And you read stories of 70,000 euro being stolen from a house, and you want to wonder why anybody is keeping 70,000 euro in a house. And then it translates into a demand from the state and pressure on the state to take care of you when things go wrong. But it doesn't translate necessarily into a realization that you have to do things to insure yourself in case things go wrong. Some people are led to tax evasion. If the state is not going to make good use of my money, I will do it myself, and I will try to keep money for myself. and significant lack of trust in the state and in the financial and insurance sector that they have products that can help us with our financial well-being. So these have very important implications. Now, how can households be empowered? So here, a lot was mentioned by Dr. Bianco on financial education. I don't need to repeat it. I want to add a couple of dimensions. Maybe we learn from our peers. So interaction with peers can also help us and empower us. Financial advice, we learn from professionals. Financial products that were also mentioned. So one is delegation to manage the accounts. So we don't do things, but professionals do it. But also the design of products, so default options, so things that happen automatically without us ticking a box or pushing a button, and simpler products that people can understand and can more easily invest in. These are important. And of course, technology, and this was also mentioned, websites, apps, digital campaigns for saving, budgeting, and planning. Now, here you can see lots of papers written by members of our network and others who should be members of our network on financial literacy and on outcomes. And there have been studies that show that low financial literacy make it less likely that people save for retirement. That more likely they have lower wealth, participate less in the stock market. They have tendency to use high-cost credit, more limited tendency to diversify, likely to have a higher mortgage when young, more likely to report diminished spending capacity and limited available savings following a financial crisis. So there are lots of things that go bad when you don't understand how markets work and how products work. We have a current project, actually with a PhD student from Goethe, Camila Duraj, who is here tonight, and with colleagues from sociology and from finance. And we did a sort of mixed methods approach with German households. So we picked 25 German people, and that had some money to invest, so had some basic knowledge of what is going on. And we hired professional interviewers, and we got them talking about money without telling them we are interested in the stock market or whatever. But of course, after a couple of sentences, they started talking about the stock market. And without us, inflicting our theories upon them or our priors on them as to what might be factors, we just let them talk, and then we analyze those things. So a lot, good news for all of us working on the topic is that a lot of our models, got confirmed. People, unprovoked, came up with explanations that we always give. But we got some new fish, so to speak. We fished some new fish. And in particular, the idea that people don't understand anything about market efficiency. So they think that before you invest in the stock market, you have to study individual companies, and you can identify the safe products, the products for which there will be demand in the future. So you can identify, that's their term, safe stocks, where you cannot lose your money. And you have to keep monitoring every company if you enter, and you have to keep trading to time the market. And this way you can avoid losses. And of course, if you have to do this, then we have a joint explanation for non-participation, for overtrading, and for under-diversification. Because if you think you have to do this, and it's a lot of work, you are more likely to stay out of the market. That's the non-participation part. If you do participate and you think you have to study every company and keep trading, then you overtrade while you are in the market. And if you think you have to do for every company that you invest in, then it's a lot of work to study more than 3-5 companies. So we have an explanation for under-diversification as well. And in all the years, 2-3 decades that we have been studying these problems, at least I have not thought that people would be thinking necessarily this way and behaving this way. We also did, in the context of the same study, we did a vignette study. We presented people with these 3 types. The analytic type, who has a lot of financial knowledge, selects 10 basic, top companies specifically and constantly adjusts his portfolio. The passive guy, who has little financial knowledge and just invests in ETFs and doesn't do anything, doesn't touch the portfolio. And a random guy who is just throwing darts and picking stocks randomly. And guess what? I mean, Germans are very confident that the random guy will do horribly, right? Because this is so irresponsible. And the analytic guy will do the best, the guy who's over trading and who's constantly, trying to time the market and stuff like that. So that was, quite interesting to us. Learning from peers, what's the good news? The good news, also for us as economists, is that if people are friends with us, they are more likely to be participating in the stock market, learning from us, participating in the stock market, saving for retirement later on. So that's good for our social life. So that's a positive thing. What's the concern? The concern is the distributional implications of peer effects. So what we have shown in that paper that got published in 2020 was that the people that you talk to, your peers, must know what they are talking about, okay? Must be educated in the fields. So who are the people who are more likely to have such peers? Also people who are educated. And even if economists talk to non-educated people, people without college education, these people do not understand what they are talking about, so they don't actually benefit from these peer interactions. So if we just rely on this social multiplier, we train some and others will learn from them in their peer interactions, this multiplier is operative for the educated groups, but it leaves the uneducated or less educated groups behind. A current project that we have with the same data set is that, if people are starting their economic life and they are faced with greater wealth inequality around them and wealth mobility opportunities, so the people who take advantage of them are the educated people, the college-educated people. So they take risks and they invest in risky assets and they are more likely to increase their wealth. But the less educated people just simply don't respond, don't perceive wealth inequality as an opportunity of what is possible for them, but they perceive it as an opportunity for others. And they are left behind and, maybe in bitterness and disappointment and creating social polarization and ideas of unfairness. Can we rely on financial advice? Some of you are in the financial advice sector to remove barriers to product access. And the literature here has long identified conflicts of interest. So financial advisors who both advise people what's good for them and are selling products, they face this conflict of interest. And the solution to this is to have fee-only advisors, and this has been implemented. But still, what continues to be the problem is that the people who are using financial advisors tend to be the people who need them the least. So they are the rich, they are the educated, they are the experienced, the older people. And the young, the inexperienced, the people who are facing lots of career risks and everything in their lives, they are not somehow finding their way to financial advisors. On average, being advised contributes negatively to outcomes, but there is a lot of variation in that. So there are, good advisors and less good advisors. So we did in another current project, we are doing a comparison. How does peer advice compare to professional advice? So we got people from the street, and we got professional financial advisors, and we gave them vignettes. Imagine this potential investor, what risky portfolio share would you recommend for such an investor? And we gave them a list of characteristics, and we are watching what they are using, what they are not using, etc. So some good news, both the professionals and the lay advisors are responding to individual characteristics in ways that are broadly consistent with our theories. So we didn't see wild and crazy responses to these vignettes. The second finding is, but it is a bit known in the literature, certainly for professionals, is that the advice that professionals but also lay people give is influenced by their own portfolios. So if they themselves are holding lots of stocks and a lot of risk, they tend to recommend more risk to the others. So this suggests that, advice actually reflects quite a bit the opinions and the beliefs and the attitudes of the advisor. But the third finding that we found is that actually young people are likely to be discouraged from investing in stocks if they listen to their peers or to their parents. So they are much more conservative. These groups are much more conservative regarding young people than professional advisors would be. So the fact that young people are not reaching professional advisors actually discourages their stock market participation at an early stage and at a measured pace. Now, finally, I want to mention this new initiative. We have built an international network of Greeks and hopefully soon also Cypriots across all disciplines, and it's called Convos. And one of the initiatives of that is this ENIA that I mentioned. And it is modeled, and my colleagues from the network will recognize elements, almost plagiarism, here from the so-called Think Forward initiative that has supported our own network for about 5 years, the 5 years of its life. So the objectives of that initiative for Greece, and hopefully in the near future for Cyprus, is first to promote research that has relevance for Greece, hopefully for Cyprus, for influencing behavior of people. So that's academic research with a twist that can have some impact on behavior. Secondly, entrepreneurship, an accelerator hub that's going to support startups and technological developments that, apps, online banking and financial products that help with saving and avoiding excessive borrowing. And of course, the dissemination hub that, also Dr. Bianco mentioned, reaching the adults is an extremely important thing. The Think Forward initiative has been very successful, although it is discontinued now. It reached, in those years, more than 100 million people worldwide and changed the behavior of nearly 7 million people. We are doing this, it's a private sector initiative with the National Bank of Greece and Accenture Greece, and of course Convos, this global network, but hopefully it will be expanded with others. That's it.
Thank you.
Okay. Thank you.
So the next speaker is Dr. Jumana Salehin. Floor is yours.
Is it going to be?
Hopefully they're doing, if you...
How is it?
Okay.
No, we'll go with here first. Yeah. Thanks. But there's slides.
Let's,
Yeah, thank you very much. I'm very happy to be here today. Thanks for the invitation. I'm going to make 3 points today, but before I do, I want to say, I am coming from Vanguard. As a practitioner, I'm offering some thoughts. I used to work in the central bank. I've been at Vanguard for 3 years. Vanguard is the second largest asset manager in the world, and we've been in operation for 50 years, and we have 50 million clients worldwide. So I want to share with you some of the things that we've learned along our journey. So my 3 points today on empowering households to make good decisions. First of all, financial decisions are complex. It's a theme, we've been hearing about that. And one chart that I'm going to show you in a minute that is that outcomes vary so much across the EU and globally. And then the question is why, at the end of the day, people, human beings, a species, we're actually the same, but our environment is very different. We're affected by policy, our culture, the country, our experiences, when we enter, and that really affects our mind and how we act. The second point that I'm going to make today is that while financial literacy is vital, and that we've been hearing that today, pension policy and savings incentives, so fiscal policy, pension policy, tax wrappers, tax incentives, these are also really, really important as well. And we think it creates an ecosystem that boosts financial literacy. So the analogy I like to give here is, you can be taught in the classroom or you learn on the job. So if you have pension systems that are provided by your government, you tend to engage with that, or savings or tax wrappers, and therefore you actually learn a lot more. And then as you learn, you can use that learning in your everyday investments for yourself. And then my third point is that financial literacy has its limits. We've been hearing that as well. And coming from Vanguard, I want to argue as well that clear and simple products, and Vanguard is known for low-cost mutual funds and ETFs, is another way to empower households in their financial decisions. We've been talking about the scores today. Even if you score 100 out of 100 in some of those questions on financial literacy, will you still be able to invest your money well? Actually, probably not, because there's a lot of biases that we face. For example, we don't want to invest, we have loss aversion, we don't want to make a loss, and so many other biases. So it's not the only thing. I was thinking before I came, discussing with my colleagues, is it a complement, is it a substitute to financial literacy? And I think it works for different people in different ways. So it can help even people who are non-financially literate. And I'm going to give some examples. So here's my chart. Apologies if it's a little bit small, and you can see, but this is really, it's really a correlation. It's a scatter plot. And it just brings out a few things. So first of all, we have the chart of financial literacy, and this is actually using the Lusardi and Mitchell global study, which is a little bit out of date, 2014, those numbers. And the share of deposits in financial assets, those are taken from an IFAMA study from 2022. And you see this negative correlation, right? So first of all, you see that the countries in the north of Europe, I've put the US and UK there as well, in the yellow dots, tend to have higher levels of financial literacy, and the southern countries, Portugal, Cyprus, Greece, Italy, tend to have lower levels of financial literacy. And what you observe from this simple correlation is if you are more financially literate, you hold less of your assets in the bank, and you hold it somewhere else, whereas if you're less financially literate, you have the money in the bank or under the mattress. And what really surprised me is if you look at the EU average, deposits are 40% of assets are held in banks, and 34% of EU assets is held in cash, right? So we know that cash generates very low returns, so that's how the money is being spent. My chart on the right is kind of about, well, what about if we look at deposits and pension assets? How does that look? And you observe this. It's not so strong, but you still observe a mildly negative correlation, saying, well, if you're not holding your money in those deposits, where do you have the money? you have more of it in your pension funds. But of course, it's a complex space here. And we know that, there are some places like the Netherlands and Denmark, which are really known for their pension savings. UK, they've made auto-enrollment. So they say everybody who has a job, not everybody, you have to be above 22 and earn above £10,000 a year. You get automatically enrolled into a government pension scheme. And that's been rolled out after the global financial crisis. So it's a relatively new thing, auto-enrollment, it's called, in a employer-based pension fund. So this is kind of one correlation, and I totally appreciate there's a lot of factors that affect decisions. So correlation is not causation, and it's not two-way. There's a lot of factors. So what are those factors? So I thought it was useful to just sort of plot this out and really talk about some of the factors affecting a household when they make those financial decisions. And I tried to categorize it as people. People are the same everywhere. I've argued that. You have your risk attitudes, you have your cognitive biases. What are these biases? There's, first of all, recency bias. Whatever happened the last few years, you think it's going to happen in the next few years. There's also loss aversion or overconfidence. We talked about 3 different personas that Michael showed, the random guy, the analytic guy. So you have different biases. You also have different demographics. Magda spoke about, women are less financially literate. They have different preferences. We also see the young, the old, different ethnic groups. And then there's country-specific factors, the culture, the employment, the macro market, housing. We talked, people love housing in Cyprus. Guess what? They love it as well in the UK, right? We buy houses because there's little land. And if you think about the supply of housing, it's very limited. There's lots of regulations on building new homes. So we see a lot of people moving their money into housing as well. And then on the bottom of the chart, I talked about pension and tax systems, how that's really important to create that learning environment as you go through your life. Consumer protection and regulation, that's so important for trust. If you have trust in the system, then obviously you're going to be, money is such a sensitive thing, and we know that depending on the culture, people don't necessarily want to talk so much about money. So where you put your money is going to really depend on financial regulation and education as well. And then I'm coming to this from the Vanguard side, so I want to emphasize products, competition in markets, transparency, simple products and simple advice. These things are very important as well. I really feel that what can really move the dial is policy regulation. And policy and regulation has an interplay with products as well. Because if the regulation, I'll give you some examples of that, if the regulation is such that those products can come into being offered, consumers can gain. So let me talk a little bit about the evidence. So I wanted to start with clear, simple products, said how that's important, low-cost indexing and ETFs. So many of you would have heard of the Vanguard founder, Jack Bogle. He 50 years ago came into the market, and what his mission was to give all investors the best chance of investment success. And he was really thinking about the everyday investor. He wasn't thinking of the wealthy people. He was thinking, how can we make markets closer to the everyday person? And he invested in, if you Google Vanguard principles of investment, these have been around for 45 years. And this basically says, okay, there's financial literacy, but this is just saying, hey, guess what? All you need is these 4 things. Anybody, you need to have a clear goal. Why are you saving? Are you saving for retirement? Are you saving for a house, for your children? You need to have a balanced portfolio. Don't put all your eggs in one basket, diversify. Low cost, absolutely critical to the Vanguard way of thinking. And discipline, we talked about timing the market. Don't try and time the market. And we show lots of evidence on this. We did some research earlier this year, which was published in the Financial Times, which showed that investors in Europe who invest in European domiciled funds, like UCITS funds, they've actually saved £80 billion or 90 billion euros in the fees from index trackers. So, there's quite a lot of value there. And then I have this chart on the right. What does it show? It basically shows 2 things. One, if you're in an active product, you see the losses, which are the negatives, and then you see the gains. So there's a lot of volatility, right? So if you're going to be in an active investment, your active guy who picks the stocks and decides which stocks to do, if you want to have those gains, hey, guess what? You've got to have the stomach for those losses. And actually what we find is that there's quite a lot of loss aversion in human behavior. We don't like losses, and we see that in many academic studies. People don't like to make the loss. And that's why if you look at the index funds, which are the yellow, you just see the up and down. These are the excess returns over and above the benchmark. The benchmark is the market return, which is about 6% over very long horizon, say. So here this is just saying when are you above the benchmark, when are you below the benchmark. So the bottom line really of this chart is to say the reason why index funds have been so attractive is because it helps people maintain discipline, and it takes it from the individual who finds it difficult to make those choices and who doesn't like the loss. They know they're going to get the market return pretty much bang on, and therefore it can overcome some of the cognitive biases, sidestep the need to make the difficult choices, and just get the return at the end of the day. We talked a little bit, Michael talked about advice, and we did a study last year, and I wanted to talk a little bit about advice, and we did a study across these three economies, Germany, Italy, and the UK, of 1,000 financial advisors serving 200,000 investors. And what we found is that the total cost of investing is higher in Germany than in Italy and then in the UK, and they're significant here, over 95%, and the 3 stars are above 99%. So the differences are statistically significant. And what do you see? So we think cost is really important, and if you don't control your costs, you can have a very, very different outcome in terms of your returns, because this difference on an annual basis of 70 basis points between Germany and the UK can compound over time, and it gets bigger and bigger and bigger. And so these small differences in costs on an annual basis really can eat into 20% of your total portfolio return over the longer time horizon. So it's really important to think about your costs. But why is there this cost difference? When we dig into it, we found that in Germany, a lot of the advice is what we call commissions-based advice. So that's on one end. And then there's the independent advice, which is on the other end. Commissions-based advice basically says you go to them, they give you a product, and then if they sell hedge fund A's product or bank B's product, bank A or B will give them a commission. So we don't think that that model is necessarily that good, because it's not clear whether they are selling that product because of the commission they get or whether it's because it's good for the individual. And we're here today talking about empowering the household, so we're not sure it's great for the household. Whereas in the UK, commission-based fees were banned in 2012 as part of financial regulation. And what we found there is that independent advice, and it's now one of the MiFID rules, is independent advice is fee-based. We think that serves consumers better, because when it's independent, you have a duty under the financial regulation to give your customer independent advice. This product is good for you, not because of the commission that you're going to get. So we think that transparency on the costs is really important. And another point I'd like to mention on this slide is holistic financial advice. So when we ask these advisors, can you please classify yourself, tick as many boxes as apply, we found that in Germany and Italy, they tend to be more of an investment advisor. You can see the numbers here, 65%, 86%. And in the UK, the advisors were much more holistic. So they classified themselves, oh, I'm a tax advisor, I'm a retirement expert, I'm an investment advisor. So you are giving more holistic advice. So when your circumstances are going to differ, and the financial advisor has that big picture of your needs, empowering you to make the best choices. I also wanted to talk about this is some research that we've done with Vanguard's own data. So we have over 500,000 clients in our direct-to-consumer platforms. You can just log on and invest your money. And when you log on and invest your money, it asks you, do you want to enroll in a monthly savings plan? And you might say, yeah, I'm going to put in whatever, 50 euros, 100 euros, or whatever you can afford every month. It can be anything between, as low as 1 to as much as you want. And what we found is that talking to automatic behavior, people who clicked the box, which was 1/3 of our clients, and said they wanted to do this automatic things, so it's the power of defaults and not inertia, they actually had higher balances, showing here in the middle bar, the average and the median was higher than people who just did it every now and again. Oh, by the way, I might as well do it. The tax year is coming to an end. I've got some tax incentives, so I'm going to do this. So automatic savings plans or automatic plans can drive better financial outcomes. And in the US, we found as well that people who are nudged through this, hey, you got this much money in your account, do you want to invest it? And they respond much better. So outcomes are also, determined by how the products are designed. So I want to end where I started. I wanted to come back to the scatter plot here, but I've added in, the first two are exactly the same, but I wanted to add in another one with the capital market participation as well. So this is basically saying, how much do I invest in the capital market directly as a stocks or bonds or mutual funds? And that's the definition that we've used here. And you can see here sort of a similar sort of story, that if you hold more money in deposits, you hold less money in the stock market. And the only point here really is typically deposits give you lower returns than what you would get. If you hold it in a bank, you probably get virtually close to zero, especially the low interest rate environment we've been in, whereas in the stock market, you're probably getting over the long run more like 6%. That's over the long run. So it's not about short term, it's about long-term investing. So finish where I started. It's a complicated field. There's no silver bullet. What I mean is that there's no one thing you can do that can empower households in their financial decisions. Instead, we need a package of reforms. The complex decisions, you have to think about the system as a whole, the pensions provisions that are provided by the government, and tax wrappers. And financial literacy we think is great, but we think it has its limits. And so products and low-cost products is another way to go forward.
Thank you very much. So last but not least, from the US, Diane Thompson, and then we'll open to the floor for questions. So let's see how this will work. Diane, the floor is yours. You are muted, so you have to, yeah. Thank you, we can hear you.
Great. So I'm super excited to be here. I really enjoyed
So please stay with us. We'll go straight to the questions, actually, Q&A. There's microphones going around. So let's start with back there. If you can state your name and your affiliation, it would be useful.
Great, thank you. Hi, my name is Michael Boutros. I'm an assistant professor at the University of Toronto. Thank you all for the great pen. I hope you don't mind if I drop the titles and honorifics. So, at the University of Toronto, I'm developing a course in household finance, and I was posing a question to myself: should I design this course to help my students with their financial plans, or to help my students become financial planners? So in listening to all of your great points, there was varying dimensions of this. I think with Jumana, it was really about let's design simple products and have people not need to be too financially advanced. And I was with Magda's presentation, I think it was really about let's empower people to make good decisions. And then Michael had evidence on kind of both sides, that maybe financial planners right now aren't doing a great job. They're more interested in their own kind of gains than helping people. So if I'm a regulator, how much should I allocate my resources, which are very finite, to training the next generation of people who are going to help the average household make good decisions? And I think about the medical world, in which right now at this point in time, most of the knowledge about health is in a very small group of people who are doctors. And the systems we have, generally, we think they incentivize them to give good medical advice. So I pose the question to you: should we be training people to be better financial planners themselves, or should we be training people to go to financial planners, but then we need to make sure that the planners are doing kind of a very honest job? Thank you.
Magda, are you going to take that? Or?
An impossible question. Well, yeah, the problem is very well put. We have to do both, in a sense. We have to allocate our resources in the right way. I think, in a sense, as a regulator, I think I need to make sure that I put quite a lot of resources in making sure that the supply is a good supply, that we are doing the best that we can so that the final users can take a decision in a reasonable way, in a knowledgeable way, having all the elements in a transparent way, having eliminated as much as possible the wrong possibilities, in a sense. And then the second step is yet provide them instruments, tools, first to know how to defend themselves if something still goes wrong, and then to make all the choices where I cannot substitute them. Because even if I avoid all the wrongdoing on the market, then there will be some decisions that they have to take by themselves. I cannot force the consumers to take insurance if he doesn't know about it, even if it's good for him. Or I cannot force him to get out of deposits to get into something that takes a bit more risk but also a bit more returns. So I think it's a stepwise decision also from the regulators to allocate resources. First, make sure that the environment is as safe, as conducive to his well-being as possible, and then allocate the rest of resources in making sure that he has the knowledge, the awareness of taking the rest of the decision, but also knowing that if something goes wrong, he can do something, and he knows where to ask for this. But of course, the balance is very difficult.
Thanks. Any other questions from the audience? Michalis, yes.
Thank you very much. You mentioned that...
Michael Sari is former finance minister.
Sorry?
I'm introducing you.
So it's technology.
Yes.
Thank you. Now it works better. You mentioned that scoring high in educational literacy, in financial literacy, doesn't necessarily mean to good outcomes. Casual observation, I think, suggests that the opposite may be true also, that people that don't necessarily recognize terms like resilience or positive interest rates, but have high levels of curiosity and intelligence do very well. And I'm wondering whether your research has looked into it in terms of outcomes. how well do these people do? The other one is that behavioral economics has done very well in getting, for example, vaccination rates up to during the COVID crisis, in getting tax compliance high, in getting better educational choices. So I'm wondering, have you looked at it more systematically to see at the tools that have been developed? And one last observation, I should have mentioned, I am now chairman of Astrobank, and there we have a good example of a low-cost and simple product in wealth management and private banking, where people with different backgrounds come, and basically the product is investing in government bonds of different countries. And in a period of low interest rates, if you offer somebody 3.5–4% rate of return compared to practically zero on deposits for many years, it's a very simple and attractive, and people feel secure with it.
Michael, you want to say something? Or you want to?
I can kick off. I mean, I think, the evidence shows that these nudges from simple products can change behavior, and that the change in behavior comes from everyone, right? Whether you're financially literate or you're not financially literate, right? So you asked about that. Do we have any evidence that these nudges or simple products make a difference? And I think we do have that evidence that makes a difference for both high and low financially literate people.
Yeah, I mean, one thing that, also covers part of the previous one, but also this, it is important to do, the regulation and, to make sure that the right products are there. But something that had come up also at some point with ESMA and, the European Commission, thinking about how to do things, and I was a little bit involved in that, was in addition to the range of products that are available, telling people what range of classes of products are available for different purposes. There is a gap, which is, what is the next step? Okay, so I have studied now this website. I have taken the course. I know more about, this, that, and, compounding, diversification, etc. Where do I go next? And that step seems to be missing. And it is a difficult step because the regulator cannot say, go to Astrobank, right? Because it's the regulator. They cannot advertise your product, right? What can they do? And, one thing they can do, and they don't do so much, is to say, okay, go to a financial advisor, and here is a list of questions you can ask a financial advisor, right? These are things that you should be getting answers to, okay? That is a next step. Or, look at websites, for ETFs, for example. This is an ETF. Where do you go next? I was talking to somebody yesterday. He said, he's trying to invest from Cyprus. He's giving a Cyprus address to ETFs, and they say, no, we don't want Cyprus addresses because we never can do the KYC, the know your customer things for Cyprus. And he doesn't have a way to invest, right? So doing the next step, and guidance for the next step, in addition to regulation and everything, I think is an important thing. Yeah.
I'll ask a question. I mean, we heard about if I think of financial education as coming from the demand side, I think I agree with Diane when she says, well, it's necessary, but it's essentially not sufficient to solve all the problems. So there's two parts: the supply side, how do you generate competition in a system, and then the second part is how do you have good regulations that are effectively these enforcement actions or some effective sort of regulator. The question is, how come you don't observe John Bogle's in so many? There's so many other countries in the world. Cyprus is supposed to be part of a capital markets union, part of the Eurozone. It's very hard to actually go and open an account with Vanguard in the UK, which is, in the broader European thing, even in Frankfurt, for example, which is very, it doesn't, competition doesn't magically come. So how come we don't have so much competition in some countries? How come, do you have a solution of how do you generate that? How do you generate somebody? How do you generate John Bogle in Cyprus, let's say, or in 200 countries like Cyprus, I think?
Yeah, I mean, I think that's a really great question. I think that's what I think, the regulation and the policy, when I talked about my map, that's the one that can really drive. If you create the right incentives, the businesses will come in with those low-cost products or greater competition, or say, banning commission-based advice, for example. That's something that is being discussed at the EU level. At the moment, they've taken one step for platforms. They've banned it, but not for advisors. But I think some of this is entrenched, Alex, in the culture. It's been there for years and years and years, right? So a lot of this it has to be, it's a long process of change, but I think it has to start with the regulation and the policy saying this type of advice is allowed. It's independent. In the UK, if you call anyone up for advice, they have to go through a whole range of things that they say to you to say, I'm an independent financial advisor. Please make sure what I'm giving you, you don't have to take this advice. It's optional. There are certain things they have to say to make sure. So I think regulation can create the right incentives to move the market away from a captive market to a more competitive market. And then you will see the rise and the Jack Bogles when that environment is there. But culture is also playing a role.
Well, in Europe, for example, the Payment Directive, the PSD2, was a regulation that really pushed for competition in the payment, created an asymmetric market favorable to entrants, to non-incumbents, and forced competition for open banking. So regulation can do a lot.
That's a good example, actually. So on that note, that regulation can hopefully make the system more competitive. Lena will close our session.
All right, thank you, Professor Michailidis, for moderating the discussion, and a special thank you to our esteemed panel members for the very insightful and thought-provoking contributions. So as we conclude today's session, let me take a few moments to reflect on the key themes that emerged from today's discussion. So one of the central points raised was the increasing importance of improving financial literacy as a means to empower households in making sound financial decisions. As noted, higher levels of financial literacy lead to increased, but not reckless, participation in financial markets, such as the pension funds, diversified investment options, which can enhance long-term financial security, especially to those in vulnerable groups. In countries like Cyprus and Greece, where the rate of deposits as a share of financial assets is high, the discussion underscored the need for targeted financial literacy initiatives to shift this behavior towards more diversified investments. Practice beats theory, I agree, and this is especially relevant in Cyprus, where low financial literacy, limited participation in pension funds, and a heavy reliance on bank deposits continue to pose challenges. So another key issue discussed is the reliance we see on advice from peers or non-experts when making financial decisions. While peer learning can sometimes be helpful when there is transfer of economic knowledge, it can also be problematic, especially when conflicts of interest arise, leading to households to make poor financial choices that undermine their financial resilience. So addressing this requires not only improved financial literacy, but also access to trustworthy, unbiased financial advice. Building on this, the role of consumer protection was emphasized as essential to complement financial literacy efforts. Financial literacy alone is not enough. So strong regulatory frameworks are necessary to protect households from financial risk, misinformation, and unfair practices, particularly in an increasingly digitalized financial environment. Ensuring transparency, low-cost financial products, and accessible professional advice is crucial for fostering trust and encouraging households to engage more confidently with financial markets. Financial inclusion can be achieved only when both financial literacy and proper consumer protection policies are in place. Without these dual pillars, households may remain excluded for financial opportunities, or worse, for victims to financial products they do not fully understand, or even scams, as we have very recently observed. So financial inclusion is about creating a system where everyone has the knowledge to participate and the protections to feel secure in doing so. That said, it is important to remember that Rome wasn't built in a day. So reiterating the governor, enhancing the financial resilience of households is not a simple or quick task. It requires time, it requires dedication, it requires continuous effort. It is a gradual process that depends on the collaboration of all relevant stakeholders, but rest assured that each step we take brings us closer to building a financially educated and resilient society. Initiatives like introducing financial literacy programs in schools and lifelong learning for adults were highlighted as critical steps towards these goals. So the National Strategy for Financial Literacy in Cyprus, endorsed by the Council of Ministers, provides a clear roadmap for improving financial literacy across all demographics in Cyprus. With the fully operational Cyprus Financial Literacy and Education Committee, Cyprus has laid a strong foundation and developed the necessary infrastructure to drive these efforts forward. Through these coordinated efforts, the financial well-being of households can be strengthened and a more stable and secure future can be ensured for households and the broader economy alike, enabling us all to better withstand future challenges. With this short wrap-up, our session has come to a close. Thank you all for joining us today. Special thanks to the Governor of the Central Bank of Cyprus, Dr. Batsalidis, the CEPR members, the panel discussants, the organizers, and of course to you, our guests. We can now continue our bilateral discussions and further explore the idea we just shared just outside this room at the cocktail reception. Have a very good evening, and thank you once again.
Okay, on time.
Let's